Welcome to today's Explainer, everyone. Okay, so if you've been keeping an eye on the commodity markets lately, you've probably noticed something wild. A massive, totally counterintuitive shift. Today, we're decoding a domestic policy change that is quite literally rewiring an entire sector. We're talking about the recent sugar export ban and the absolute ethanol revolution happening right behind it. We are, and I mean this literally, transforming sugar cubes into drops of highly valuable fuel. Let's just dive right into the data.
Right off the bat, we're hit with a major paradox. Why on earth did a government export restriction essentially create the new gold in the commodity markets? Think about it for a second. Just recently, we saw the government hike import duties on gold and silver to a steep 15%, right? All to control the flow of money and manage domestic reserves. Normally, that kind of strict government intervention sends absolute shockwaves through the market. And now, they've slapped a restriction on sugar exports. The immediate gut reaction from most investors? Panic. They see export ban and assume the absolute worst. But as we're going to see, for a few perfectly positioned stocks, this restriction is actually turning them into highly profitable, rapidly growing assets. No way, right? Let's look closer.
Now, you might be asking yourself a very logical question here. If a company suddenly loses the ability to export its main product to the global market, shouldn't its stock price just absolutely tank? Well, traditionally, yeah, that's exactly what happens. A traditional export ban usually equals a crashed stock price. When a government steps in and restricts exports, their goal is almost always to control domestic inflation. It's a defensive move. They want to flood the local market with supply to keep everyday things, food, logistics, petrol, cheap for us consumers. So normally, an export ban means a company is stuck with all this excess inventory, domestic prices crash, their margins get squeezed tight, and profits absolutely plummet. It's a classic domino effect. But to really get what's going on here, we need to look past those surface-level economics and dive into the real maths. The government isn't restricting exports just to make sure your morning cup of tea stays cheap. Actually, that's a nice bonus, but it's not the point. This is a massive, strategic, macro-level mission. The real objective? Saving our precious foreign exchange reserves. This isn't just some simple food pricing policy, folks. It's a profound pivot toward green energy and total economic self-reliance. To truly grasp the sheer scale of why the government is doing this, we have to look at the single biggest drain on our foreign exchange. Consider the central pain point of our entire economy. Global crude oil jumping from $70 all the way up to $114 a barrel. Wow. Whenever we see a massive spike like this, it triggers a completely catastrophic domino effect at home. Because we rely so heavily on imported crude, when oil prices surge, our rupee significantly depreciates against the dollar. We end up burning through billions of our foreign currency reserves just to keep the lights on and the country running. And the result? The cost of importing anything goes up. Logistics become a total nightmare, and literally everything gets more expensive for you and me. So here's the government's silver bullet solution to that crude oil crisis: ethanol blending. The government has mandated this genuinely brilliant pivot. By banning sugar exports, they are intentionally trapping all that excess sugar domestically. But instead of just letting it rot in warehouses and crash the local sugar market, they are actively forcing mills to divert that excess sugar into producing ethanol. This ethanol is then taken and blended directly into our petrol supply. It's an absolute masterstroke. By turning sugar into fuel, the government drastically cuts our reliance on expensive, imported crude oil, which directly takes the pressure off our depreciating rupee. Okay, so we've established the macro reasoning, right? The grand strategy to save foreign exchange. But how does this actually translate to your investment portfolio? We need to zoom in from the macro impact to the micro impact. Because down on the ground, this overarching government policy is creating a massive split in the market. It's literally creating two entirely different paths for companies operating in the exact same sector. Depending on how a specific company's infrastructure is set up right now, this export ban is either going to be a total disaster for them or the greatest catalyst for growth they've ever seen. Let's look at a tale of two entirely different business models to see what I mean. First, we have your traditional sugar mill. Let's call them Company A. Their whole strategy? They just make sugar. So when the export ban hits, they're stuck with literal mountains of extra stock, they're forced to sell at incredibly low domestic prices, and their profits completely tank. But now compare that to Company B, the modern distillery. They saw the writing on the wall and they made massive investments in ethanol distillation plants early on. So instead of crying over this export ban, they take that excess sugar and sell every single drop of ethanol they produce directly to oil marketing companies. And the best part? They're selling it at a fixed, highly profitable price set by the government itself. So their result isn't a crashed profit margin. It's a guaranteed, totally recession-proof income stream. Right, so how do we actually leverage this data? Here's the action plan. First, you want to scan the market specifically for companies with massive ethanol capacity. These are the guys actively helping India save billions in foreign currency, which basically makes them the absolute darlings of government policy right now. But listen, here is the golden rule. The market rewards early belief, not late excitement. Do not just wait around and chase the momentum when these stocks are finally blasting across mainstream news headlines. You've got to position yourself based on the data right now, securing those predictable income streams way before the rest of the crowd catches on.
Now, while the upside here is massive, protecting your capital is absolutely paramount. Remember, we're dealing with commodities and energy, which means we are highly vulnerable to sudden geopolitical shocks. Things like the recent turbulence and proposals involving Iran. Because of this, you absolutely must hedge your trades. If you're betting big on this ethanol sector rotation, use tools like put options to protect your capital from sudden, unforeseen policy changes or global black swan events. Always protect your downside. Which brings us to the ultimate realization of this entire shift. You really need to let this sink in. These aren't sugar stocks anymore. They are energy stocks. Let me say that again. When you look at a modern sugar distillery today, you are no longer looking at a simple food commodity business that's at the mercy of domestic grocery pricing. Absolutely not. You are looking at a high-growth, heavily subsidized, fundamentally critical energy play. This sector rotation is profound, and honestly, treating them like traditional sugar stocks is going to cause you to completely miss their actual valuation. So that leaves me with one final, incredibly important question for you. Are you moving with the data? Or are you just moving with your emotions? The world of investing is changing at lightning speed, and reacting emotionally to headlines like an export ban will just leave you behind. But if you rely on the real maths, you can spot these hidden opportunities, like the huge ethanol revolution we just decoded. If you found this explainer helpful, please go ahead and share it right now. Let's spread the awareness so your fellow investors can spot these incredible data-driven opportunities early, rather than just reacting late with the herd. Stay focused, keep analyzing the real data, and I'll catch you in our next explainer.